Ladies and gentlemen, good day and welcome to the Landmark Cars Q1 FY'25 earnings conference call hosted by Monarch Networth Capital. As a reminder, all the participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Rahul Dani from Monarch Networth Capital. Thank you, and over to you, sir.
Thank you. Good morning, everyone. On behalf of Monarch Networth Capital, we're delighted to host the senior management of Landmark Cars. We have with us Mr. Sanjay Thakkar, Promoter, Chairman and Executive Director of Landmark Cars, Mr. Ariman Thakkar, Executive Director, Surendra Agarwal, CFO, and SGA, the IR partners. So without wasting much time, I'll hand over the call to Mr. Sanjay Bhai for his opening remarks. Thank you, and over to you, sir.
Good morning, everyone. Thanks, Rahul and Monarch, for hosting us. The results and presentations are uploaded on the stock exchanges and the company website. I hope everyone has had a chance to look at it. Let me start the call by saying that I am satisfied by where we see our company today. From a macro perspective, various factors played out that affected the overall demand for passenger car vehicles in the previous quarter, keeping the market sentiment subdued. During the last quarter, elections and related uncertainties affected customer sentiments, delaying purchase decisions. You may recall that the overall passenger vehicle industry degrew a little after many years in the month of May and June. I'm talking about all India numbers. This led to significant increase in inventory levels across board at the dealerships. As per FADA, the new car inventory, FADA is our apex body of Federation of Automobile Dealers Association. The new car inventory levels reached 67 days for new cars by end of June, a big jump over the last quarter. I am happy to state that our company is in a significantly better position, where we have in fact reduced our inventory over last quarter with a tight level of monitoring. Our new car inventory stands at approximately 41 days. We were able to do that at the cost of some margin and earnings, but we believe that we are in a very good position as we enter into the festive period. We have been emphasizing on a fair balance between OEs and the dealers. Our company has continuously strived to be in a good position vis-a-vis its peers by being a dominant retailer for its OEs and have been able to get favorable treatment. Another satisfying matter has been our timely completion of several projects that we had undertaken. We have completed 11 outlets before time and within the budgeted capex and made them operational. You may refer to slide number 10 in our presentation for more details. We are confident that the balanced projects will also be completed well within or before time. We are well aware that for a sustained profitable operations, our cost of operations needs constant monitoring. We have taken internal targets of reducing our personal expenditure as well as other expenses to 4% each. We have embarked upon this journey with full vigor. We are forming a separate Landmark shared services vertical housed under one of our subsidiaries where all our employees of our call center, insurance, HR, accounts, drivers, etc. will be housed and would work in a brand agnostic way. We expect sizable amount of saving in our manpower cost because of this one move alone. I am happy to report that the personnel cost for existing outlets have reduced over last year, same quarter. We have also formed internal task forces to reduce our other expenses like electricity, housekeeping and security, fuel, etc. And we are seeing good traction to achieve our goal. The results of these initiatives should be visible in the coming quarters. There was a question on the quantum of front-loading of expenses in case of new outlets getting operational. We have tried to address this issue by classifying our business as new and existing. We think that the business generally takes 3 to 4 quarters to normalize. So we have kind of defined what the new outlets are to take away that subjectivity. Had it not been for the newer locations, our profits would have been higher than the same quarter last year, in spite of the last quarter being the most challenging quarter in recent times. The consumer sentiment, which was low till July, is improving this month onwards as the festive season nears and the seasonality kicks in. Aryaman will explain why the coming quarters are looking better. In a nutshell, I feel satisfied with what we have achieved considering the external landscape and look at the future with optimism. Our fortune is strongly interwoven with the state of the Indian economy. Thank you.
Thank you. Let me give you all a performance update on some of our partner OEMs. Mercedes-Benz witnessed its best ever sales in H1 of calendar year 25 by selling 9,262 cars in India, which was a 9% year-on-year growth. However, the ASP has increased by 22% year-on-year to 66 lakh rupees now. Mercedes-Benz India have guided for a double-digit growth this year, and it continues to maintain its leadership position in the Indian luxury car market. The company has a number of launches planned for the rest of the year, including the all-new E-Class, which is the most successful Mercedes model in India. The top-end vehicle sales continue to remain strong with a 25% contribution, and with the Maybach models showing a growth of over 100% in this period. In BYD, post the homologation of the Atto 3 a few months ago, the company has launched lower priced variants starting at rupees 25 lakhs, which should lead to higher volumes. The deliveries of the recently launched BYD Seal have also started in the last quarter. The response and demand for the car is encouraging. JSW MG Motors India is planning to launch 5 new products in the next year, starting with the new MG Windsor soon. Once all our new locations have stabilized, we are on track to become a prominent dealer for the brand. The brand has large ambitions to be the leading new energy vehicle player in India, with an aim to sell 1 million new energy vehicles by 2030. Mahindra & Mahindra is a high-growth brand and will significantly outpace the growth of the PV market this fiscal. The Thar Rocks, the 4-door version of the Thar, will be launched on Independence Day and is already garnering a lot of attention. They have an exciting model pipeline and announced capex of further 26,000 crores over the next 3 years. Our operations in Kolkata are ramping up and the outlets in Hyderabad will be operational soon. For Kia, India is a long-term story and they are focused on building on the success they have had so far. The new Carnival and EV9 are planned for launch in the second half of FY'25. Our operations of Kia in Kolkata have started recently and Hyderabad will be following soon. In Jeep, the OEM has floated attractive consumer schemes this month, which has resulted in a boost in customer inquiries and bookings. We are expecting offers to continue for the remainder of the year, which will help push volumes. However, we are still focused on taking corrective action wherever necessary. We have made the Jeep facilities in New Bombay common with Renault, and the showroom at Worli will be shared with BYD. We are exiting the remaining 2 outlets of Renault in Punjab as a result of our focus on healthy unit economics. In Mumbai, being the only partner for Renault, we have agreed with the OEM to provide us with financial support till the time the volumes increase. The shared facilities with Jeep will help bring further efficiencies. The pre-owned car business has been performing well with a revenue of 27 crores in the quarter and 69% year-on-year growth. We are confident of surpassing last year's performance. The after-sales performance remains stable and continues to deliver strong and consistent results. The EBITDA margins at 16.5% for the quarter is lower than our long-term average of 18%. As the newer outlets ramp up over the next few quarters, this will normalize. The existing car park in these locations is helping show progressive improvements in business performance. On the technology front, we have launched our new e-commerce website. The site has new as well as pre-owned car listings and will help strengthen our omni-channel approach. In a period of less than a month, we have seen an organic increase in new users by 36% and user engagement by over 65%. We will be working on increasing the visibility and traction to make this a source of quality leads and inquiries for our brands and elevating the customer experience. I would urge you to have a look at this new website. As India continues to premiumize, we are confident that we have partnered with the brands which will lead this transition and will be successful in the long term. Early indicators from August are quite encouraging. The customer inquiries, test drives and footfalls are showing an upward trend. OEMs have also started introducing customer offers which will help drive this momentum. We are expecting this to continue for the remainder of the year. With the onset of the festive season, the overall retail environment looks promising. I will now hand it over to our CFO, Surendra Agarwal, to take us through the financial highlights.
Thank you. Good morning to everyone. I wanted to share some key metrics, how we have performed in this quarter. We continue to be the highest contributor in terms of volume for multiple OEM. During the quarter, company pro forma sale at rupees 1165 crore as against 934 crore for the corresponding quarter, growth by 24.6%, out of which revenue from the existing outlet is grown by 15%, outpacing the passenger vehicle industry. The balance growth is coming from the new outlet. Our company focuses on premium and luxury brands. The average selling price of new car sale for a company group level for the quarter has gone up by 13%. In the quarter, after sales turnover has increased by 14.3% year on year. We are expecting the growth to improve when the new outlets start delivering to their potential. Due to full scale fixed cost, the operating margin for the new outlet are currently not at par with the existing outlet. With the recent capex and investment towards inventory, the depreciation and amortization plus finance cost for the new outlet were on the higher side. Coming to the financial number of Q1, the gross margin for the current quarter is rupees 161 crore as against 143 crore in Q1 FY'24. That is growth of 12.7% in a challenging quarter. The EBITDA for the existing outlet has grown by 7.5% year on year. Our consolidated basis is 6.6% if we include the new outlets. Profit before tax of existing business has increased by 19.4% due to initial losses in new outlet. Overall profit before tax is showing decline of 52.4%. Cash profit for the quarter is rupees 18.5 crore as against 19.7 crore in the same period last year. Thank you. Hello?
Yes?
Yeah. We can now open for the question and answer.
Okay. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Lokesh Manik from Vallum Capital. Please go ahead.
Yes. Hi, good morning, Sanjay ji and team. My first question was on the new OEM additions in Kia and M&M. Now what I understand is that we had a thought process that we're going to be entering partnerships with OEM where it makes business sense for us, where competition is low. You get to enjoy the service car park and the service revenue from these OEMs. So if I just look at the cities that we have entered, Kia, where we are entering 2 cities, there are already 7 dealers there. M&M 2 cities and 19 dealers there. So has there been a change in the thought process to move more towards mass market OEMs now compared to niches like Honda, which had a good cult following in Gujarat, or Mercedes? So has there been so if you can just share your thought process behind these partnerships, it would be great.
Yeah, Lokesh, thanks for bringing this question up. Maybe this question may be in the minds of some others, so let's answer this straight up. There are a few filters that we have before we choose a partner. What had happened in the last year is that we were partners with companies where they were not adequately participating in India's growth story. That was one reason why we had to go with people who were participating unquestioningly and not dependent on one or the other model to be then completely relying on. The second filter that we have is that we want to be, and we have no change in that method, is that we will want to be in a premium and luxury play. Now, how luxury is easy to define. How do you define premium? We are saying that our filter is around 10 to 11 lakh rupees of ASP without GST. Now, if the company falls within that, it works for us as far as the unit economics is concerned in sales as well as service.
Okay.
The cities that you mentioned and the brands that you mentioned, let me kind of address that. You mentioned that Mahindra & Mahindra has 19 dealers in Hyderabad, which is really not so. It is the 19 outlets. If I'm not mistaken, the number of partners will be 4, not 19.
Number of outlets, correct.
Yeah. So where we need to do the math on the store wise, and that is what we have kind of applied the filter of. As far as the Calcutta Kia is concerned, we have taken over the operations of an existing Kia dealer who wanted to exit this business, and the sales as well as service has started to kick in from this month. We have taken over the operations from this month itself, and the service as well as the sales revenue is picking up. The other answer is that we want to go deep in a geography. Now, why Calcutta and Hyderabad as against, say, Coimbatore or Chennai, is that we are already in Kolkata with Mercedes-Benz, and now with Kia and Mahindra coming, there will be an operating leverage which we want to achieve. Sharing of bandwidth of manpower and a lot of other expenses. The same answer goes for Hyderabad. So we choose a geography, we go deep with it. We choose a OEM and we go deep with it. I hope I have been able to answer your question.
Yes. In detail, sir. Thank you so much. The second question was, are there any OEMs that are left that you have not had a discussion with at the premium of the luxury end? and you may have rejected them based on certain filters of yours, but are there any that you haven't even initiated conversations with, if you can highlight?
What I can say is that Landmark is a preferred retailer for practically everybody in the country. I mean, at the cost of sounding a little pompous, let me kind of say that. So we are in constant dialogue with people wherever it makes sense. We go. But currently we have a task cut out. There are two objectives that we are working on for this year. That is to reduce the cost of operations, which we are completely focused on. And the other is to complete these outlets that we have taken well within time. So if we are looking at adding 20% of our turnover within by exiting this year, we have like 1/5 of the company that we are adding this year. So we have a lot of stuff that is happening at our end. But what has happened is that we have been able to templatize this. What gives me more confidence is that now we know that we can undertake so many projects simultaneously, complete them in time, and get them operationalized. Now, this is something which is giving me a lot of heart.
Great. So you don't see any threat from these 4 dealers in Kolkata impacting your new ventures or taking more time to break even? You don't see that threat?
If you were to get into the growth brands, I'm not talking about the luxury brands. As far as the luxury brands are concerned, so far it has been a 2-horse race between Mercedes-Benz and BMW. If you want to kind of go to a little bit of premium, it will be difficult to have complete exclusivity in that. We have competed with, whether it is Honda or Volkswagen, we have competed with the dealers in those locations have come on tops. It is a separate issue that over a period of time we have been able to take over these competing dealers. In fact, most of our acquisitions has been of the competing dealer in the same town.
Understood. All the best, sir, for the future. Thank you so much for the questions.
Thank you. The next question will be from the line of Neha Jain from Vajrayana Securities. Please go ahead.
Hello.
Yeah, hello.
Please go ahead.
Yeah, sir. Good morning. So I have one question. Can you give some guidance for FY'25 and more importantly FY'26?
I will repeat my last sentence of the speech, which I said that, and I will read. Our fortune is strongly interwoven with the state of the Indian economy. So I wish I knew exactly where we are. What I'm saying is that we are feeling good about what we have achieved in this, and the growth is back, and hopefully the profitability will also be back soon.
Okay, sir. Thank you.
Thank you. Before we take the next question, I would like to remind the participants that you may press star and 1 to ask a question. The next question is from the line of Prolin Nandu from Edelweiss Public Alternatives. Please go ahead.
Yeah. Hi, Sanjay bhai. Thank you for giving me this opportunity. So a few questions, Sanjay bhai. On your opening comment, you mentioned that the margins in after sales have also been affected by opening of new outlets. Can you just help me understand this? Because last quarter also we had discontinued certain operation, because of which year-on-year growth was probably not the right way to look at it. But are some of the new outlets also impacting the margins in the after sales business?
Yeah. So what happens is that some of the outlets, like a Mahindra outlet or a MG outlet that we have started, they are yet to reach its full profitability level. Some of them, we are seeing not gradual, in fact, quite a rapid increase. Like we opened our Mahindra business in middle of March. And every month we are seeing like a 20%, 30% jump in the after sales business. But it is still to reach its potential. That's why we then thought that it takes around 3 quarters for the after sales business in existing brands also to kind of stabilize, for us to make a name in our local market and get the customers accustomed to visiting us. And that's why the question that you are asking is where it is coming from. But my sense is that this will, because they are not contributing right now the way they should.
All right. Understood, sir. So if you did a breakup of, old and new outlets for your sales business, right? New car sales business. If we were to do a similar breakup in your existing after-sales outlet, would we be earning 18 to 20% margin? Is that assumption correct?
So what we have declared is a console thing that we have combined both sales and service over here. So it would be close to around 18% for existing brands. I can say that.
All right, sir. That's encouraging. Thank you. And sir, secondly, in terms of your market share for Mercedes, right, while this is not a number that is worth tracking on a quarter-on-quarter basis, but from here on, in terms of you opening some new outlets as well for Mercedes, where can this go, in probably a few quarters' time?
So you are right in saying that this quarter is not a great way to kind of measure it. 1-2% here there happens. Like for example, in Gujarat, we had a great demand for diesel cars, and who would have thought? And the company didn't have diesel cars in the first quarter because that was not what people were buying earlier. So we could not deliver some diesel cars that way. So let me answer it this way, that Mercedes globally has been working and prefers to work with larger dealers, larger partners. And the one other thing which there are two reference points that I can give you. One is that in Hyderabad, where we will be opening our workshop as of now in the next few weeks, that we are looking at getting it done maybe next month. We were chosen to expand in a completely different market by them, in spite of us being their largest partner. Now, the global, when I had visited some conferences, I met a large dealership group in Korea and Taiwan and all, which had 40% market share. So, as the country matures, the desire of most companies is to deal with large, organized, professionally run companies. So this, I'm hoping, will go up over a period of time. I wouldn't want to put a number.
All right, sir. Thank you so much. Last question from my side. Now, if we look at our quarterly operating profit since listing, right, it has been in the range of 50 to 65 odd crores. And if I were to look at your business from an unit economics point of view, let's say if you have just one showroom and one after sales service, then it's a 20% odd ROC kind of a business, at least, right? If not more. So I'm just trying to figure out that when do we, break this number in terms of our operating profit? And is it also fair that once this expansion normalizes, the next phase of expansion, whenever it happens, right, in terms of store outlet, would not put this much pressure on our balance sheet in terms of increasing borrowing and also in terms of our P&L? Is that a fair assumption to make?
It is a fair assumption to make, because if you see the point, we are talking about a 20% growth in the company this year alone. Now that kind of when the denominator increases, when the company becomes bigger, then the percentage that we are adding will not be as high. We are doing a kind of a shock therapy to ourselves to kind of get into a growth trajectory and get us into a new orbit. Now this is unlikely to be all the time. We haven't done this much of expansion in the same financial year ever. Good thing is that we are executing this, but you are right about the ROC, you are right about normalized operation, and it will all happen.
Sure, sir. Just let me push one last question, right? Since you mentioned that, it takes 3-4 quarters for the new showroom as well as after sales center to normalize, then maybe this year for the next few quarters there would be some drag because they wouldn't mature yet. So, what would you want us to probably evaluate your performance on? Because maybe the operating metrics, operating profit for that matter, might be weak for the coming couple of quarters. What should we look at, right, to understand that we are on the right track, right, in terms of the progress that we are making in terms of expansion and the kind of revenue that we expect from some of the newer ventures? That's it from my side, Sanjay bhai. Thanks a lot.
Yeah. So, one thing is that when we are saying newer outlets, now newer outlets, some of the ones that we have reported are already some 9 months old. It's not that everything has happened in this quarter. Some of them have happened in December, some of them have happened like last, maybe September or October. So, they will move out of this new bucket. So that's something which I can say. As far as some of the Kia outlets and Honda that we have acquired, they are actually existing businesses that we are acquired, and we do not see any kind of drag in them because we are taking over existing or semi-existing kind of operations. So I will need to kind of have a more detailed thought on how to guide you, but that's what I can say as of now.
But then, is that fair that probably both in terms of some of the macro headwinds that we felt in Q1, plus some of the drags of this new showroom, the worst in terms of that, both these headwinds is behind us, and from Q2 onwards, there should be sequential improvement?
I would say that from Q3 for sure, there will be good improvement. We even in these brands that we are talking about, we will have new cars that are getting launched, for which we had all been waiting, and that should turn things around.
Great, Sanjay bhai. Thanks a lot and all the very best.
Thank you.
Thank you. The next question will be from the line of Sabyasachi Mukherjee from Bajaj Finserv AMC. Please go ahead.
Yeah, hi. Thanks for the opportunity. First question on Mercedes volumes. If I look at this particular quarter, Mercedes volumes were flat, all India basis, YOY terms. But if I look at our numbers, I'm getting a sense that probably we have, clocked more volumes or gained market share or something like that. Can you please throw some light on it?
Yeah, Sabyasachi, what has happened, and as what Aryaman said, that the ASP, the whole world somehow is tracking the number of cars sold. Now, what the newspapers are not tracking is the increase in the ASP. So what we actually did was that though we sold a little, the number of cars that we sold is higher than the last quarter, but the ASP has increased more.
Yeah. So just a follow-up here. If I just derive the Mercedes sales from the pro forma and reported numbers, I believe the sales value has gone up by 35%. In the opening remarks, Ariman mentioned that the ASP has gone up by 23%, I think, YOY to 66 lakhs.
The point with so Sabyasachi, the thing is, as compared to the previous year, same quarter, yes, there is an increase in the volume as well as the ASP. What Sanjay bhai is mentioning is the compared to the previous quarter, the Q4. Against the Q4, there is a lower number in the Q1 of Mercedes-Benz, but as against the last year same quarter, the quantity also increased.
In our case, but what he's asking is that Mercedes India did not grow.
So my question is Mercedes India YOY quarter 1 FY'24 versus quarter 1 FY'25, volume numbers were same.
We have grown a little. We have grown a little, which would include some kind of maybe demo cars also, which we may have sold. Yeah. But I'll need to check the numbers and come back to you on this. Sabyasachi, it's a fair question.
Got it. Second thing on the M&M Mahindra outlet that are lined up launches in Q3. Hyderabad 3 outlets and 3 workshops. My question is, Mahindra is coming up with this big, launch tomorrow, 15th August. Why are we not gunning for launch of this outlet in this quarter itself, preponing the launch from Q3?
My compliments, Sabyasachi, for tracking this closely. I'm happy that you are doing a great job. Now, we are exactly doing the same. Though there is going to be a launch, the cars at the dealership are going to be available in the first week of September. This is what we are closely in touch with the company, and we are hoping to get this operationalized in the beginning of September, at least one outlet where we can get this done. The thing about Hyderabad was that we have been getting into some brown or greenfield projects that we have been taking. So if you see, our plan was to actually launch it in the third quarter. If you see our presentation on page 10 earlier, it was that. So understanding that this was something which we would have otherwise missed, we have preponed a lot of stuff. A lot of people are putting day-night work over there, and I'm hoping that at least one outlet of ours will get operational in the next three weeks or so to capitalize on this.
Great to hear that. And all these 3 outlets would be new outlets, right? We are not acquiring some existing ones.
No, sir. These are new ones.
Got it. On Honda, we understand that there is some brand fatigue, or there has been no major blockbuster launches for this brand for a long time, right? Why are we adding Honda outlets? Can you just help me?
Surely. So there are 2 answers to this. One, Honda will have a big launch of Amaze in the next 3 months, 4 months or so, which actually sells a decent number of vehicles in Gujarat, Rajasthan, Madhya Pradesh area. So that launch is happening. The thing in Jaipur where we entered is that initially there were 3 dealers of Honda in Jaipur. One shut down, the second one we have acquired, and the third may or may not be there in some time. So in this business in which I have been saying, it's not only the numerator but also the denominator of how many dealers are there. Honda has been extremely profitable for us for the last 25 years because of the service revenue, the car park that is there. And if you get a larger geography, it becomes a good kind of a business to be. Also, to answer your question, there is an entry that we need to do in a certain geography where we want to overall focus. I answered initially to Lokesh as to why we went into Calcutta or Hyderabad as against others. The same answer is in Jaipur. Jaipur is a fast-growing geography. Now we need to enter there for other OEs who we want to partner with going ahead, maybe next year, some other time. They will want some geographical presence. So when we entered like the Hyderabad market, we had to first go with Mercedes-Benz, who gave us the after-sales business, and after that Mahindra and Mahindra as well as Kia were comfortable signing up with us. So it is like an entry to a large market with a very kind of a predictable thing that we are going in for Hyderabad, for Jaipur.
Then a follow-up to this is, can we expect more brands outlets coming up in Jaipur for us, Landmark?
That is the macro thing, whether it is Indore, whether it is Hyderabad, whether it is Calcutta, Mumbai. This has been the company's strategy. Now, whenever a new brand opportunity happens, we would prefer to be in the geographies that we already are, and go into geographies which are growing but we are not present.
Got it, sir. One last question from my side. On this, presentation, slide number 10, where, we have shared the expansion plan status. Anything else are we planning for this entire financial year, barring whatever is there in the presentation till Q3 FY'25?
No, sir. This is what we have.
Okay. Thanks. That's all from my side, and all the best.
Thank you.
Thank you very much. Next question will be from the line of Raj Shah from Ambit Asset Management. Please go ahead.
Hi, sir. Thank you for the opportunity. I wanted to understand the gross margin decline during this quarter. So how much of it was due to the addition of newer OEMs, whether Mahindra or MG are at slightly lower gross margins for us, and how much of it was because of higher discounts during the quarter?
So yes, there are both elements affecting this quarter. As we explained earlier, is new outlet after sale business is not with their potential, so their margin is lower. Therefore, the blended margin of the company is lower after sale. Then the second was we have not done the wholesale to tighter control on the inventory. So again, point.
Maybe I can answer that. What has happened is that in the existing brands also, Raj, and I spoke about it a little bit in my speech, but let me explain more in detail. The point is that the industry works on a discount or an incentive on a certain amount of wholesale that we do from the factories. What we did consciously in some parts of May and definitely in June was to forego those incentives because we wanted to reduce our inventory. Now we actually were able to do that quite successfully, and this, if you ask me, one of the better things that has come out of the last quarter is that when the whole industry is devoured by the inventory that is aging and all that, we are pretty lean as compared to most of the other guys. So, but that has come at an expense of some margins. It's not only the margins that we gave in the market to sell the stock, it was more that we did not wholesale from the OEs and get that extra margin.
Okay, understood. So, like, what would be the average inventory that you would be comfortable with going forward? And what is the percent increase in discounts if I just want to compare on a Y-on-Y basis?
So, Raj, the inventory of new cars at the beginning we were at around 41 days, and which is still outside of our comfort zone. So we are happier with around 30-35 days of inventory. When let the world be at 60 days, 65 days, we don't want to carry that much inventory. So we will still try to reduce it by 5-7 days if we are able to do it. But now we have done most of the dirty work has happened over here. This is something that we will want to kind of do with. And because we are in many of the markets, not all, I mean, not everywhere, but many of the markets, we are the only retailer of that OE. And the OEs are giving so much discounts right now. The good part is that the OE purse strings have opened up, and that is why the demand is also back. So the need for the dealer to put more from their pocket is really reduced.
Okay, understood. So just last question from my side. On the Mercedes front, how is the supply chain right now? Like, we were facing some supply issues. And second is, when do we expect the E-Class Mercedes to be launched? Whether you have any communications from the brand side, what kind of growth are you targeting for this financial year?
So Santosh Iyer has guided for a double-digit growth for the year. That was the last interview of his that I saw. The E-Class is getting launched in the last quarter of this calendar year. So we will see some numbers kicking in for us in the next quarter for E-Class. Obviously, it is something that eagerly people are awaiting, and we are seeing a great amount of interest. Sorry, what was the other question over there?
What is the supply chain issue currently?
I mean, I wish every car that the customer wanted was available. We had some issues with the diesel and all that. Now that keeps on happening in this industry, but it's okay. I mean, we still are short of some or the other car, but nothing very major.
Okay, thanks a lot.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. I repeat, please limit your questions to 2 per participant. The next question will be from the line of Amarkant Gaur from Axis Capital. Please go ahead.
Yeah, thank you for taking my question, and thank you, Sanjay, for such an elaborate presentation. That's really helpful. I had two questions, one flowing into the other. One was, basically, if I'm looking at the numbers, that breakup that you have provided of existing versus new, your PBT is about 12 crores, right? And if I look at the PBT of Mercedes standalone that you have provided, plus if I add some bit from Landmark Cars East, probably the overall PBT from existing non-Mercedes brands would be maybe 1 or 2 crores. So that's if you can shed some light on that number, which are the brands probably that are doing relatively better, and where is the most of the drag coming from?
Yeah, Amar, this is a good catch, and but the good part, the answer to this is that apart from Mercedes-Benz, we have now BYD, which is decently profitable for us once the seal deliveries have started, and the Atto 3 will only happen from September onwards. So over the next 1.5 years, we are pretty bullish on BYD once the supplies are. We have cars on the road and the workshops then start kicking in. We are making decent amount of money in Ashok Leyland. Honda has been a little subdued, but it has always been a little profitable. So actually, from the bouquet that we have, people are more or less contributing the way they were supposed to. Some of them will have a better second half. Honda, for example, with the Amaze and all getting launched. And we have reduced the inventories in some other, we have cut in Renault. So some of the loss-making things are getting behind us. So actually, if you ask me, it's not only a Mercedes-dependent company that we have, fortunately.
Understood. So that leads to my second question. So now that we are in the process of opening a lot of stores, right? And also there are certain brands which are little behind in terms of profitability, and they also need to catch up. So from that perspective, breaking down into these two bits, how do you expect in terms of not in absolute numbers or any guidance on the numbers, but in terms of absolute tracking of performances over the next maybe 2, 3, 4 quarters or beyond that? How should we look at the overall performance trending from the current levels? Like maybe earlier some of the participants you also talked about maybe from Q3 it should start to improve. So if you can break it down a little bit more for us to understand that.
So Amar, the reason why I had said Q3 was that from Q3 we will have the Windsor, which will be available for MG. We will have the Atto 3, which will also be being delivered. We will also have the Mahindra vehicles that will start kicking in. We have the E-Class, the big one, that will also happen. So that was my reason for saying that from Q3 onwards things will happen. After sales right now we are not so much concerned about. It is the sales that we need to push. We see our business that sales has to also be responsible for generating profit. That's the way we look at it. It comes with insurance and finance and other incomes. And the moment the sales numbers happen, everything starts looking hunky-dory. The first quarter wasn't the best for sales for any brand. We believe that it will now pick up. So the way to look at it, Amar, would be to kind of estimate the number of cars that will happen over there, and we can do that math there.
Understood. So where I was coming from was mostly from the brands that you are adding, and there is a operational challenge. Obviously, it takes time. You indicated maybe a couple of quarters, maybe 3 or 4 quarters it takes for the brand to stabilize and then start performing. And from the new brands, the volumes, additional volumes are going to come, and these are the brands that are doing better as well, right? My question was more from the perspective of existing brands. Now that other brands, excluding Mercedes and even if I exclude BYD as well, then the profits are relatively lower. So how do they move in line with our overall company performance?
So, Amar, they look good. Existing brands are BYD, which looks good. BYD is not in new. BYD is in existing. Jeep is in existing. So, Jeep, for example, we are seeing a good amount of traction. What has happened is, and this is not only for Jeep, the customers have been there. It is just that they are now seeking deals. The good part about the industry that we have seen in the last few months was that the inquiries were pretty much there. The people were not closing. Now that the discounts are there, they believe that the festive season is upon us, the government formed, and everything is now business to normal. So, and the OEs have opened the purse strings. So this has happened in Jeep also. Some 3 days back, the Compass price was corrected. And we believe the same thing will happen in other models very soon. This is one kind of an experiment. So Jeep volume will pick up. Now this is where the 2-3 big moves I see coming up. Honda and Volkswagen will be stable for next quarter. Amaze will be a big driver for us going ahead because we sell a lot of Amaze in Gujarat.
Okay. Thank you, Sanjay bhai. I'll fall back in the queue. Thank you so much.
Thank you. The next question is from the line of Shashank Kanodia from ICICI Securities. Please go ahead.
Yeah, good morning, sir, and thanks for the opportunity. So I just wanted to check on Mercedes-Benz. So last year, Mercedes-Benz kind of underperformed the luxury car market segment because of some supply side issues and lack of model launches, right? This year, they were supposed to go for some 10 model launches, but in the first half, they still underperformed the market. So do you see this as a structural issue to the brand as such, wherein, in luxury car market, other brands are kind of getting more prominence?
No, I see what has happened is that the pecking order is now set. Within the luxury brand, Mercedes is clearly numero uno. This will be the 9th or the 10th year running where they will be the market leader. Now, people who are coming from a low base, their percentage growth is better, and that's why we believe with a few percentage points that the company has been underperforming. What you are saying is right, but also look at the ASP. Now, the sheer numbers, what you are saying is right, but the ASP increase has been much higher than any other brand, is my sense. 25% of what we sell is all top-end vehicles. So this is... we believe that like the E-Class comes, every brand has some kind of a tailwind when new models are launched, and our tailwind will come when the E-Class is getting launched, in number terms.
It is like, for example, JLR is going for domestic manufacturing, right? So even these guys are looking at good numbers. So do you see, obviously we can maintain the number uno position, but the volume growth effectively being less than the competition and it impacting us as well, as in, this is something that you fear or something of that sort?
The JLR number, the CKD happening is obviously they are taking away some volume from the luxury industry per se. The nascent industry size of 45,000 has to significantly grow. We are all kind of taking the pie out of that 45 and maybe this year 50,000 or whatever. This number, which is 2% of China and significantly lower than any like a Korea or a Japan, has to grow multifold. We are at around 1.1% luxury penetration. Now you see pockets of India which are actually growing. Let me kind of answer it this way. In a place like, say, Madhya Pradesh, we have seen our sales kind of double this year. So this is a starting point, and I won't really lose much sleep over market share gain or a loss for a quarter or a half year. It's a correct question to have, but we have a kind of a decade of journey ahead of us.
Thank you. Second, say on the new vehicle car sales, your margins were good 2.5% in the past and dropped to 1.7% last year. We further dropped to 1.4%. So we do understand that, because of new outlets that you're opening, it's on a declining path. But what is the sustainable rate going forward? Like you mentioned, 18% for after sales. So like 2.5% is a kind of a sustainable range for this. And when do we start attaining that?
We would see. This is also in the last question to Raj. I believe I answered that we've let go of some of our wholesale incentives If whatever the normalization is happening, we are hoping that from October onwards, life will be okay, the demand and supply will be at an equilibrium, and things will be back to business as usual.
So what is the sustainable margin rate that you're looking at that division?
On what the new car sale?
New car sale.
So it has to be upwards of 2%. That's what we are talking about.
Okay, and we are confident Q3 onwards, you should start telling that.
We are hoping that that's what will happen. I mean, I only hope that the economy sustains and we don't get any shocks here.
Right. And sir, as a management and promoters, just want to get a sense. So, we spend more time, meeting investors and do for roadshows, or we spend more time getting our house in order and getting the P&L right?
Yeah, that's a good question because I spend maybe 4 or 5 days of a month in trying to meet the investors, but that's not that much time that really gets there. It's actually what is happening is that I have been working around 7 days a week. So there is no holiday generally, and there is no sleep that gets more accumulated.
I hope you're getting the point I'm trying to drive, sir. We would want to wait a better P&L performance from Landmark. It's been quite some time that we've been disappointing on the P&L front.
Sure.
Thank you so much.
Thank you very much. The last question for today will be from the line of Chirag from Ratnatraya Capital. Please go ahead.
Hi, good morning. Thank you for the opportunity. Just a clarification question. So the slide 26, which talks about our ambition of getting to 4% on both personal expenses and other expenses, is that the exit number that you want to get to? I mean, the slide reads as...
Yes. Because that's where the turnover will also kick in, and the measures will also...
For Q4, that's what you mean?
That's what we are seeing, yeah.
Understood. And for this quarter, is it possible to share the gross margin for the services business? You can just bookkeeping question, so that's my only question.
Can you repeat this question, your gross margin?
For the services business. Just the services business, the after sales.
Profit of margin, EBITDA margin and margin.
I can take it offline otherwise. Gross margin is there.
Yeah. Surendra, yeah.
We'll give you the separate.
Yeah, we have last 5 minutes, so if there is any other question, yeah.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Yeah, I think most of the questions were answered, which included the closing comments that I wanted to basically give. Really, there is nothing more that I need to add. I have full confidence in the team that I am leading, and we are working harder than most people I know to get what we want to give, because we are all stakeholders. I mean, not only our countries, our business is interwoven with the country. My and our employees' future is interlocked with the future of the company. And just so that people on the call, if they are interested, know that all the senior management, the director level guys, and including me, did not take any PLB or increment for the last year. So the pain of any other investor is shared by everybody. Now this needs to be understood and respected when we are doing this. And sometimes the situation which is beyond your control also needs to be appreciated. I think again, as I'm saying, I personally believe that I'm feeling happy with the way we have steered the company so far. And this business is not to be looked at on a quarter-to-quarter basis. I'm answering these questions, and I'm learning every time something new and taking it home. But this is over a period of time that this business needs to be looked at. And once we look at it a few years from now, we will look at this as a passing memory of the calls that we are having today. Thank you.
Thank you. On behalf of Monarch Network Capital, that concludes this conference. Thank you for joining us, and you may now disconnect.